Hello, and welcome to The Income Generation, the show where we share valuable financial information for that critical period in life when you're either in or approaching retirement. I'm David Scranton, your host. Even if you haven't actively started your retirement planning, if you're over 50, there's a very good chance that you've at least done some research, or at least started looking into your options. If so, you've probably come across a lot of how-to rules and guidelines for saving and investing. In fact, most books, most websites, and TV shows devoted to financial topics focus mainly or focus entirely on this how-to aspect of investing. In other words, things like what strategies to use, how to pick a stock, when to buy, when to sell, and so on and so forth. In other words, most books and resources on financial planning focus on external factors, or what I like to call the outside game. And while all of that is important, most people don't realize there's an even more important inside game that all these how-to books seem to be ignoring. Given what's happening in the financial markets and the global economy today, I don't think there's ever been a more critical time for retirees and people approaching retirement to understand the inside game, which is why I'm making it the focus of today's show. Simply put, the inside game deals with all of the internal elements required for successful saving and investing. The mindset, the knowledge, the principles, and yes, the core values. Without those, how-to rules and guidelines are not only basically useless, but they also could be downright dangerous in today's economic climate. I'll talk more about that on the market breakdown segment of today's show. You'll also hear some valuable insights about today's markets from a guest, Jon Najarian, professional options trader. In fact, as regular viewers may recall, when we talk about the inside game, this happens to be the focus of my new book coming out this month, Return on Principle, 7 core values to help protect your money in good times and bad. The core values I identify in the book essentially comprise all of the critical components of the inside game. If you have them and you apply them, or if your financial advisor has them and applies them, suddenly you're in a position to understand and judge all these how-to rules and strategies with a much more critical eye. You're prepared internally to address the external elements. And I can tell you from experience, this is really the whole key to successful investment planning. To illustrate this, I want to open today's show by sharing my 7 core values and giving one example for each of a well-known successful money manager who exemplifies each value. I think it's a great way to illustrate the importance of each value and to demonstrate how the pros all recognize the importance of the inside game and why they embrace it. Oh, and by the way, these examples may look familiar to you because all but one of them have been guests on the Income Generation show. So, first, the first core value essential to the inside game is overprotection, which is focusing on financial defense and protecting your assets. In my opinion, no one exemplifies this value better than Warren Buffett, one of the most successful investors of all time. Buffett's well-known 2 rules of investing are as follows. Rule number 1, don't ever lose money. Rule number 2, don't ever forget rule number 1. In other words, overprotection. The next core value, detail orientation, has to do with the ability and willingness to look beyond headlines and basic information and look beyond the basic rules to recognize and understand important details. Let's face it, investing is indeed all about the details, and few people demonstrate that better than economist Peter Morici, who was a guest on our show earlier this year. Morici's studies and articles often show how details can reveal truths and insights that the surface story just doesn't quite seem to tell. This is crucial to investing. Diligence is the next core value, which means the willingness and ability to stick with something day in and day out, whether you feel like doing it or not. Let's face it, investing can be a grind, particularly if you're focused on fixed income investing. Believe me, I know from personal experience. The fixed income world, in fact, requires even more diligence than managing stocks and stock mutual funds, which is why I believe that Mohamed Al-Arian, Chief Economic Advisor at Allianz and former Income Generation guest, is a great example of diligence personified. Coachability, the next core value, is the willingness to change direction when you're presented with evidence that it's the right thing to do. Here's a great case in point. Author and market analyst Harry Dent, whom you heard back in January on our show, discussed how changing his market prognosis at one point after he uncovered new evidence about the Dow that he had missed previously. As a well-known market analyst, that takes a lot of courage, and it takes coachability. And it's especially important, coachability that is, in this historic age of economic uncertainty. The next value that is essential to the inside game is leadership. In other words, do you yourself have the ability to deviate from the pack? When you know that the pack is about to go off a cliff in the wrong direction, do you have the internal fortitude to deviate and take the path less traveled? If you don't, then does your financial advisor have this ability? A great example here is our former guest, Steve Forbes, who demonstrates leadership in many ways, especially with regard to his flat tax campaign, which he's done consistently, even in the face of adversity over the last 30 years. Whether you agree with it or not, and many don't, he continues to champion the idea. That is leadership. Honesty, the next core value, means having the ability to be brutally honest with yourself in every aspect of financial planning. Our guest, Jon Najarian, is an incredibly great representative of this trait, who, when I asked him, for example, what percentage of assets he believed the average investor should have in stock market options right now, which are the thing that really he specializes in, his answer is brutally honest by giving us a very low percentage.
I don't think that should be probably more than 10% of somebody who's within 10 years of retirement. I don't think they should be taking shots or, making that big investment, if you want to call it that, looking for a windfall. I think they need to more or less just grind out steady returns, and that, as your show implies, the income generation is what's going to make them richer in the long run, rather than taking a bunch of shots, most of which might blow up on them.
The final core value necessary to the inside game is fearlessness, which definitely does not mean recklessness. Fearlessness is actually the value you can achieve by focusing on all the other values. The ability to live a fearless life and to enjoy retirement with peace of mind. And I would argue that all of the successful people that I've talked about here today and whom we've had on our show are great representatives of fearlessness. Again, this inside game has never been more timely or relevant because it helps you to understand how a lot of the so-called rules and guidelines of the outside game are either obsolete or potentially dangerous in today's market. So let's talk about this a bit more on today's Market Breakdown. This is fun. This is great. 3, 2, 1. But I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. Buy and hold is the only way to go. As you approach retirement, you should follow the rule of 100 or the rule of 115. Well, you need to have some money in the stock market as a hedge against inflation. Chances are you've heard or read some of these or maybe all of these investment rules and guidelines. So why is it that these rules and others like them today seem to be pointless and even potentially dangerous in current market conditions? Well, there are several reasons, but let's focus on a couple of the biggest. And then we can take a closer look at the rules themselves and more specifically how and why they fail. First, it's important to understand that the majority of advisors and people in the financial services profession have received similar training and education. In other words, we're all taught certain rules and certain guidelines ourselves. And for some advisors and authors, financial authors that is, educating the public is simply a matter of repeating these rules, these same rules that they were taught over and over again. That's definitely an easy way to do it, but it's also misleading and potentially dangerous. Why? Because, first of all, it ignores the details. It ignores diligence. It ignores honesty and all of the other core values. In other words, it ignores the inside game. The second reason most how-to rules fall short by themselves is that they neglect to factor in important realities about the financial markets. Realities you only become aware of by focusing on things like overprotection, details, and by being diligent and coachable and a good leader. In other words, by playing the inside game. The old rule of 100 is a perfect example of what I'm talking about. Now, I say old because most of the industry has gotten away from the rule of 100, but only because it's been replaced by the even more misguided rule of 115. The rule of 100 basically says that the maximum percentage of money that you should have in the stock market at any given time, and this includes stock mutual funds, by the way, can be determined by subtracting your age from 100. For example, if you're 60, the rule of 100 stipulates that you should have at most 40% of your assets in stocks and stock funds. When you turn 70, your market exposure should be 30% at most, according to the rule of 100. With the newer rule of 115, which came along as life expectancies increased, your percentage in the market would obviously be even greater. So, for example, at age 60, you'd still have more than half of your portfolio in the stock market. What are these rules designed to do? Well, in general, they're designed to reduce your stock market exposure as you get older, which in principle is a very, very good idea. But they completely ignore the fact that market risk is determined not only by age, but by other factors, including long-term market cycles and their inherent patterns. Take right now, for example, when we're still in the midst of a long-term secular bear market cycle that began with the bursting of the dot-com bubble back in 2000. Imagine if you were 60 years old in 1999 and you were following the rule of 100, and you had 40% of your portfolio in stocks and stock funds. And imagine that you stuck with that formula because buy and hold was another investment rule that you'd been taught. When the market fell by nearly 50% from 2000 to 2003, how much would you have lost if you had ridden that drop all the way to the bottom? What if you were following the rule of 100 and committed again to the buy and hold strategy from 2007 to 2009 with the financial crisis when the market toppled once more, this time by nearly 60%? That's two drops of approximately 50% or more and subsequent rebounds from 2000 to 2013. That's what I mean when I talk about market risk being influenced by the realities of long-term market cycles. Let's face it, average investors with common sense don't want to lose 50% on any percentage of their money just because some rule says that they should. The important takeaway is those drops, however, really didn't come as a surprise to everyone. Some people got out in time with no or virtually no loss at all. Understanding the market cycles and their common patterns can help you make a much sounder and more educated decision about how much market risk you should be carrying at any given time. As for today's market, listen to what our guest has to say, highly successful options trader Jon Najarian, when I asked him again about how much he believes the average investor should have in options right now, the thing in which Jon specializes. Jon shared a brutally honest answer because he understands that successful investing requires focusing on details and assessing the markets with brutal honesty, today more than ever. Stay tuned for more of our interview together with our special guest coming up next on the show. But it's also worth pointing out that our guest's whom I've asked about market exposure in today's climate have been equally as honest, and some have offered even more conservative advice than Jon's. But what about the rule that says you should always have a certain portion of your portfolio in the stock market as an inflation hedge? Well, here again, if you understand how long-term market cycles work, you know this rule is flawed because the market doesn't automatically always serve as a good inflation hedge. When the market falls dramatically into a long-term secular bear market cycle and then rebounds to its previous peak, the net gain for buy and hold investors who ride the wave all the way down and all the way back up again is zero. And even if it surpasses its previous peak, once it falls and rebounds again, the net gain again is zero. And one more time, that current cycle that we're in today is a perfect example. From 2000 to 2013, the stock market fell twice by nearly 50% or more and then recovered, ultimately experiencing zero growth over the course of those 13 years. Now, you tell me, does that sound like a good inflation hedge to you? Obviously not. But it's actually a bit worse than this. Why? Because inflation has actually worked against you during that time, decreasing the value of a nest egg that experienced zero growth. In addition to that, you are also the victim of something economists talk about as lost opportunity cost. Consider for a moment that while you're waiting and hoping to regain your stock losses twice over those 13 years, you could have been earning interest elsewhere. From 2000 to 2007, for example, you could have had your money in a FDIC insured bank CD that at that time was averaging somewhere between 3 and 5% annually. Now, maybe those numbers don't sound really exciting to you, but they definitely beat zero. What's more, they produce reliable income and are not vulnerable to the next major stock market plunge. And that's something to think about because, as I've discussed repeatedly on previous shows, the long-term bear market cycle that we're in currently likely isn't over yet, if it adheres to the lessons of stock market history. History is surely trying to tell us that these cycles last 20 years or more, on average, and experience at least three, not two, three major drops in each secular bear market cycle. And when you look at where the markets are right now compared to all the global economic turmoil and uncertainty that we're experiencing, what does your gut tell you? Does the market being at a record high or near a record high pass your sniff test? Or does it look more like a classic case of what Greenspan called irrational exuberance? Even more extreme than what we saw before the dot-com crash when he first coined that phrase. The bottom line is that these are exactly the kinds of important factors that come into play when you focus on the inside game, when you prioritize on things like overprotection, when you scrutinize details, study the markets diligently, look at things honestly, and when you're coachable and you're not afraid to be a leader. You're not afraid to zig while everyone else is zagging if you believe it's in your best interest. That's what the inside game is all about. And that's why, in my experience, it's an essential part of retirement planning for any member of the income generation, those of us over age 50. We'll be back in a moment with today's special guest. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We are pleased today to welcome Jon Najarian to The Income Generation. You might be more familiar with Jon and Pete Najarian together, or with their ads on options trading, or perhaps you've read their 2013 book entitled How We Trade Options, Building Wealth, Creating Income, and Reducing Risk. Jon, or Dr. J. Najarian, was a linebacker for the Chicago Bears before he turned to another type of contact sport, trading on the Chicago Board of Options Exchange. He became a member of the CBOE, the New York Stock Exchange, the CME and the CBOT, and worked as floor trader for some 25 years. Today, he's a professional investor, money manager, lecturer, as well as co-founder of Najarian Family Office and Rebellion Partners. Jon, welcome to the Income Generation.
Great to be with you, Dave. Thanks.
You know, options are generally considered to be something very complex by your average investor, but they don't have to be. How do you explain options to just your average middle American investor?
Right. Options, as you say, do seem mystifying, but shouldn't be really. The most common use of the same for us in everyday life is an insurance policy, where that's a put option. People like Warren Buffett love put options because they get to keep the premium for the policy they issue, and they're providing a valuable service. They're insuring the downside of some asset. You can do the same thing with a stock, and that put option ensures the downside of Google or Apple. And like I say, Warren Buffett, Bill Gates, a whole bunch of real smart people, Michael Dell, they sell puts like crazy. Why? Because they're big risk takers? No, but because they think the premium taken in is worthwhile and they're willing to buy that stock at a lower price, whereas maybe an individual investor with either a shorter time frame or less money isn't as willing to take the ups and downs in the market as much.
You know, it's interesting because you talked about hedging, and most investors, though, think of options as being risky. They think of it as speculation. You know, when you're speculating, what would you tell the average investor, somebody who's retired or within 10 years of retirement, as to how much of their money as a kind of a guideline maximum should they be using for speculation? We'll get to the hedging in a minute, but at this point, what percentage for speculation is a guideline for your average investor?
You know, that's a great question, Dave, because I think a lot of investors, the older they get, obviously the larger the nest egg generally is, but unfortunately, they probably are taking too much risk with that nest egg, something they wouldn't have been comfortable with, for instance, after their 30s and even 40s. Now all of a sudden in their 60s and 70s, they're taking too much risk. I don't think that should be probably more than 10% of somebody who's within 10 years of retirement. I don't think they should be taking shots or, you know, making that big investment, if you want to call it that, looking for a windfall. I think they need to more or less just grind out steady returns, and that, as your show implies, the income generation is what's going to make them richer in the long run, rather than taking a bunch of shots, most of which might blow up on them.
You know, using options from a speculative basis is usually something like people think about buying call options if they think a stock is going to go up. You know, can you give us a recent example of where you've had success speculating with maybe even for some member of the income generation with a small percentage of their money? Just to give an example of where using options on a speculative basis actually made you a significant gain?
Sure. You could take a look at U.S. Steel, for instance, symbol X. U.S. Steel, of course, is a steel stock. Biggest one in the world right now is Mittal, but U.S. Steel is still a pretty significant competitor. We bought some at-the-money calls in U.S. Steel. The stock made about a 4% move over the next week, but the options more than doubled. So in other words, you could make 4% on, for instance, a $20,000 investment. That comes out to about, what, $800? Or you could put that same $800 into options and turn it into $1,600. So those are examples that exist every day, whether it's Cisco, whether it's Microsoft or Google, where you can basically buy an at-the-money or just out-of-the-money call, and it doesn't take a big move in the stock, Dave, to turn that into a big winner for you.
Absolutely. It's leverage, and leverage works great when things are going well, accentuates your gains, and of course can do the opposite if things work against you, as you well know. So we're talking today on the show about the market in general, and what's your take on this? The market seems to be at a high level today. It seems to be defying gravity. What's going on in your personal opinion?
Well, I think as stated by, the likes of the Fed Chairman Janet Yellen, or Abe over in Japan, or Carney in Great Britain, or Draghi in Europe, These are all people that run central banks for these countries. And they're trying to force us, you and me, into riskier assets. That's one of the purposes of lowering the interest rates, is to make it unattractive to leave your money in a bank. They would rather have us commit capital to financial markets, and thus, by getting us out of bonds and into fixed income investing, they can hopefully drive some demand by these big companies, by Apple, by Google, by Microsoft, and so forth. And to a certain extent, that has worked. But obviously, a lot of investors, as they get closer to retirement, are feeling a little unease with the market here at these record highs. But I think lower for longer on interest rates, Dave, means higher for longer out of the stock market as well.
So without all this external stimulus, you agree that the market is on the highish side. But with all this external stimulus, it could go higher before it takes its next significant drop. Is that what I'm hearing?
That is correct. And there could be an incident, though. There could be, none of us want to see a terrorist incident, but it certainly could be that. It could be banks in Europe that all of a sudden have more than just a hiccup that could cause us to make that correction, whether it's 10% or more. That could still happen even with very low interest rates. And that's more or less, I think, why our Fed is trying to get a little further away from zero. That's why they moved rates up 0.25% last December. And it's why we're likely to see another increase, a small one, very small one, this coming December. But between now and then, David, I don't think we see any rate increases.
And that's the biggest thing that our income generation members struggle with every day, is trying to figure out, gee, if the market is defying gravity, if it shouldn't normally be at this level, but it's there for reasons, external reasons that we understand, the thought is, how much money do I really want to gamble in common stocks or stock funds? So when we come back from the break, we're actually going to talk about that. We're going to talk about ways that Jon uses options to hedge in times like this, and also to increase income for members of our income generation. Stay with us. We'll be right back after the break.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Welcome back. We're here today with options expert extraordinaire, Jon Najarian. Jon, we talked about using options for speculation, but I know as being a retired linebacker for you, it's more about defense than it is about offense in many ways. So can you talk about how an average investor can use options to protect the downside at a time like this when he may feel as though the market shouldn't be here, it's high, but yet understands why it's at this level and still increasing?
Sure. And Dave, I think a lot of investors probably are overweighted in stocks. And they are because of what you and I mentioned in the previous segment. The federal banks or the central banks have pushed them into riskier investments, taken them out of fixed income, which might be the equivalent of their age. In other words, 60% in fixed income, 40% in stocks. Doesn't really work when fixed income goes down to zero. So a lot of people are probably finding themselves with stocks that have more risk because of these elevated levels. So one of the things I would do is, in particular, if I'm in a tax-free or tax-deferred status, like an IRA or a Roth or something like that, is I would get in there and sell out some of these stocks and instead get into either in-the-money, longer-dated options, where I have a defined amount of risk, less risk than in that stock. Even great stocks like, again, Microsoft or IBM or Apple. I would rather be in the options, deep in the money options there, or in option spreads than I would like to be in those stocks. I think I can control my risk, and I think, as you say, I'm a guy who likes to play defense. Offense is great, but in particular, as you get closer to retirement, You want to have that grinder mentality. You'd rather hit like Ichiro and get, base hits and doubles rather than swinging for the fences.
So sell the stocks, buy call options to protect your downside, so you still have the upside, but with less downside. And also put options, buying puts to protect the downside. Stop losses in a volatile market like today, people put trailing stops in, as you know, and of course the market takes a big drop, you get stopped out, it runs up, and then you're sitting in cash. So do you use put options also to protect downside oftentimes?
I do. In fact, depending on the stock, whether it's FireEye, which is a volatile security stock, it's a cloud-based security stock, I would definitely have put options against my stock if I were in a volatile sector like that. But then you look at a lot of these retailers. They're having their lunch eaten by Amazon and others, soon to be Walmart now with their acquisition of Jet. And you have big downside moves. Kate Spade, for instance, handbag company. You wouldn't expect that stock to lose a third of its value in a single day, but it did just in the recent past. If you would have had a put option under the market, that put gives you the right to sell at that strike price. So just as you say, Dave, that gives you the protection so you don't have a 30% drawdown, because those can kill you or at least really inhibit your returns and keep you from living the lifestyle you'd like to live.
And most people don't realize that even if you buy a put to protect your downside, and let's say the strike price is 10% below the price of the stock, you don't have to crash through the strike price on the downside for it to work, because if it fills half that gap, the put's worth more, and people don't realize you can sell that put and actually make money on the put itself. But let's talk about income for a second.
That's true.
Because it's the income generation is the name of our show. A lot of people don't want to buy the put. They say, well, the put is, I'm only getting a 2.5% dividend. I buy the put, that's going to eat up my dividend. Those people instead say they want to increase their dividend. So how about covered calls? Are those good for retirees who still want to hold some stock?
Absolutely. It's a great strategy. Income generation from basically, I look at it, Dave, as if you own an apartment. You're in South Florida a lot of the time. So South Florida, hotbed of real estate. How many people want to own an apartment in South Florida? And if they're not living in it, do they just leave it empty? They'd rather rent it out and collect that rent every month. With an option, you could sell an option every month. You could even do it every week, but most investors, especially close to retirement age, probably makes more sense to sell monthly or quarterly options. But again, you're getting a nice chunk of income, enhancing the yield of that stock, and it's just like letting that apartment out to a renter, except they can't wreck your stock. They could wreck your apartment, they could do all kinds of damage to the apartment, but they can't do anything to your stock. They just are participating in the upside of the stock from wherever that strike price is. I think that's a great way to play the market.
So let's say S&P 500 stocks today, let's say the average dividend is 2 or 2.5%. By writing covered calls, you can get your income from 2 to 2.5 up to what level would you say in today's market?
Well, especially on an annual basis, I think you could take it into the double digits, take it to about 11 or 12%, which is phenomenal when you're looking at 0 or 0.25%, even 0.5%. For, the 2-year treasury is right around, I think, 0.6%. So in other words, if I can get 10% for owning a stock like Apple, owning a stock like Cisco or whatever, and selling calls against that stock, I think you're in a great position to, like I say, live a better life in your retirement years because you enhance the yield rather than just sitting there with that empty apartment.
At the end of the day, to get 10% in the fixed income market, you'd have to go down to the C-rated range of junk bonds. And here you can own blue chip stocks and write covered calls and get similar income. So that's absolutely great advice for people who still want to have some of their money in common stock, even though they're retired or on the brink of retirement. So, Jon, we're out of time. All good things must come to an end. I appreciate our time together today. Thank you.
Thank you, David. Pleasure to be with you in the income generation.
And for our viewers, Stay with us. We'll be right back after the break, where Morgan and I go together on set to talk about today's financial markets and what you need to watch out for. We'll be right back. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Dave, it was so fun to watch your interview with JD. Now, a little birdie told me that he was actually the first person to ever interview you and launch your TV career. Is that true?
Absolutely. It's funny, after being on the last several years between Fox Business and CNBC and Bloomberg and so on, my first interview ever was right here on Newsmax.
Oh my gosh.
And it was so funny because I was a nervous wreck.
Were you?
A nervous wreck. And he was just such a great guy. He just looked at me and said, you know, it's just two of us. It's two of us guys sitting here talking about money, and that's it. Just relax, take a deep breath. And he calmed me right down, and that's our good friend JD.
Yes, as you probably know, JD and I were co-hosts for quite a bit, and he's just so fun and really wonderful, and definitely will put you at ease.
Absolutely, that's right.
So now it's my turn to interview you.
Sounds
you know,
good.
and you alluded a little bit to that. You're doing TV, you're doing radio, you have the Advisors Academy. You are literally the busiest person I know. How did you find the time or the need to write another book?
Well, writing the book itself was actually quite interesting. You know,
Okay.
it was a process, and you know, most people don't realize when you write a book, it's several iterations. I mean, it gets to the point where after 10 or 12 times going through a book, you're not sure if you read the last change or not, and it gets confusing and overwhelming.
Right.
So you got to kind of do a brain dump in between, clear your head, and start all over again.
Okay.
But it's something I just felt compelled to do because I felt like it's something I had stuff to say that nobody else has really talked about in books recently.
Now, how important is it to kind of step back and maybe have somebody else review your material, or is that something you don't do?
Well, we do. You know, you have a series of editors. When you write a book, it's not just you writing the book. You're writing it, and then you have one copy editor, a second copy editor. At the end, you have a third copy editor. In my case, I guess I'm such a bad writer that they actually had to have 3 copy editors on it. But at the end of the day, everybody comes back with good feedback and what to put in and what to take out, because sometimes when it's your baby, it's your own stuff, you don't have as good of a view, as good of a vision as others do. So when the outsiders read it, they come back and they really give you some good input that's valuable. And now the preliminary feedback is we've got a product that is really helping educate people a lot. And it's not a lot of financial jargon. It's nice and simple. It's down to earth language.
Well, I know from your first book, you're so good at that. You know, I'm no financial genius, but you take very complicated, you know, strategies and theories, and you put it in something that's very easy to understand for anybody. You know, and I love that. So tell me, you said you had so much more to say. What type of things did you feel you didn't cover in your first book that people really need to know that we've covered in this book?
Well, it's funny because my first thought is I was thinking, gee, I've got to write something because our country has problems. Our country has concerns with the deficit, the national debt, everything going on politically and so on. But then I thought that was going to be some deep-seated economic monologue that was just people, the average folks were going to read it and not be interested in. And I thought, wait a minute,
and discouraged.
there's a bigger issue. I looked out, started looking at all the books out there, and I realized that every book is kind of like my old book. It's talking about how to, when to buy, when to sell, what to look out for. And even though my old book has some wisdom in it that most books don't have that are being sold today, that are financial books, I still felt as though It was more about the inside game. Like just about anything else in the world, most of success comes right between here. It doesn't have to do with how you do things, it's your mindset going into them. And when I realized that there were 7 core values that truly do help keep an investor's money safe in good times and bad, and I realized that a lot of do-it-yourselfer type investors really don't have the inner game, what it takes on the inside game to do it, and a lot of advisors don't really have the inner game. I said, you know what, I've got to write about this. This is something that everybody can understand.
You know, and more importantly, probably most of the advisors and personal investors, they don't even know they don't have the goods, if you will.
That's right. And a lot of times you just read a book and you think, oh, well, I know how to do this.
Right.
And the best analogy I make is it's kind of like flying a plane. You know, of course, being a pilot, it doesn't matter that I'm a private pilot, an instrument-rated pilot, a commercial pilot. At the end of the day, it's all about hours. It's all about hours and experience. And you know, there are some people who are never fit to become a pilot. There's some people that should never fly an airplane because they don't have the head for it. They don't have the mindset for it. And the same is true that some people should really never be investing their own money. And some people right now that are financial advisors, you know, they got into the business because they're interested in finance, but just like a lot of people might be interested in flying an airplane, it doesn't mean that you have the mindset or the inside game to be good at it. And that's why I thought it was so important to write that book.
Well, I think everybody needs to have a copy of your book. Like you said, whether you're great at being your own investor or your own advisor, and maybe you're not. So how do you find out? Well, read your book.
Read my book, that's right. And I believe that everyone within 10 years of retirement should go out and get a copy of Return on Principle. Why? Because remember, it's that 10 years right before retirement, that 10 years right after retirement. That is the time when it's crucial to make sure you don't make any mistakes. In fact, you'll see a commercial for my books to how our income generation viewers can order the book right after this show. But meanwhile, I don't want you to get away from basics. So in wrapping up the show today, I want to thank all of you for being part of our show once again, especially our loyal weekly viewers. But also, don't forget those white papers that are very, very important.